Good morning. Everyone is watching the yield curve. Everyone is watching the dot plot. Everyone is watching Warsh. Almost nobody is watching what's happening underneath all of it. Here's what I've been piecing together. Private credit is an $11 trillion market. It grew from $3 trillion to $11 trillion in a single decade. And it has never, not once, been stress tested in a real downturn until now. Let me show you why that matters. In February 2025, the Bank of England launched a system-wide stress test. 46 firms, banks, pension funds, insurance companies, private equity, private credit, all being stress tested simultaneously against a severe 5-year global recession scenario. A G7 central bank doesn't run that exercise for something it considers immaterial. They ran it because they see something building. And here's what's building. You've probably never heard of a PIK loan. PIK stands for payment in kind. Here's how it works. You borrow $100 million at 12% instead of paying $12 million in cash interest annually. You just owe $112 million next year. The interest doesn't get paid, it gets added to the principal. The loan grows automatically, whether the business is growing or not. PIK loans exploded during the private credit boom of 2021 to 2024. Why? Because borrowers couldn't service their debt loads in cash, especially software and technology companies whose revenue growth slowed while their debt costs rose with rates. So the private credit lenders allowed PIKs rather than forcing defaults, because forcing defaults would have required marking the loans to reality. And marking the loans to reality would have revealed that the valuations were wrong, so they let the loans grow silently, quarter after quarter, while the reported NAV stayed flat, while the fund performance looked fine on paper. Then in May 2026, Thoma Bravo and Medallia, $5 billion, full equity wipeout, second largest private equity loss in history. Blackstone, Apollo, KKR taking control. Loans marked at 60 cents on the dollar, overnight. That's what a PIK structure looks like when it finally breaks. The loss didn't build visibly. It accumulated silently until it couldn't be hidden anymore, and then it crystallized all at once. Now here's where it gets serious. The funds that deployed all this private credit capital, they were structured as closed-end vehicles. Lockup periods of 3 to 5 years. Investors couldn't redeem on demand, but those lockup periods, raised at peak 2021 and 2022 valuations, are expiring right now. The fund managers have 3 options: sell the loans at a discount, borrow against the portfolio, or gate redemptions. Some funds have already gated, and when a fund gates, the remaining investors panic and rush to redeem before the gate closes. This is a classic bank run. Now let me connect this to what you've been following in this series, because this is the thread most people are missing entirely. Private credit became the primary funding source for the AI infrastructure build-out, data centers, server farms, the physical layer of the AI economy. If private credit contracts go out, the companies dependent on it face a funding cliff simultaneously, not one at a time, all at once. If the credit channel seizes, the AI build-out faces a supply-side constraint that shows up as hardware shortage at exactly the moment the hyperscalers are trying to ramp CapEx. Now here's the connection nobody is making. If private credit seizes, the Fed becomes the only lender of last resort, not just for treasury debt, for the real economy itself. That doesn't make step 6 less likely. It makes step 6 inevitable. Yield curve control stops being a monetary policy choice and becomes an emergency intervention. Mar-a-Lago Accord mapped a controlled sequence, but private credit stress is the variable that could turn a controlled devaluation into an uncontrolled one. That's the risk. Oh, where are we right now? CCC to BB, credit spread 4.8 times wider, widest in 12 years, stress concentrated at the bottom but widening. This is structurally identical to mid-2007, not in the specific assets, in the mechanism. Opaque assets marked at cost rather than market. Hidden deterioration. We haven't had the crystallization event yet. The moment contained becomes systemic. In 2007, that was the asset-backed commercial paper market freezing. Here's what to watch. The 210 spread, currently at 27 basis points. If it inverts, the private credit stress and the yield curve signal are telling the same story. Follow inside track. We're connecting the dots before the headlines catch up. Watch the credit markets, not just the yield curve, the credit markets.